Looking at a mixed picture across the major indices with the Dow moving to the downside, but you got the S&P and the NASDAQ pushing to the upside following Fed Chair Jay Powell's congressional testimony kicking off. We're also currently getting the start of Secretary Yellen's commentary as well this morning, and all of this coming ahead of key inflation data and the start of second quarter earnings. Despite all the potential risks to come, our next guest does say that investors are going to, quote, keep climbing the wall of worry as the bull market continues. Joining us to discuss that and more, we've got Ben Lader, Bradesco BBI Head of Equity Strategy. Ben, thanks so much for being here. So you talk about a midsummer melt up. What do you think is the single biggest driver of that melt up, and how much staying power does it have?
I think there's two. I think there are two drivers of this new bull market that I think we're in the early innings of. One is these upcoming interest rate cuts from the Fed, and the second is this accelerating earnings cycle. I think both are in play, but we're going to get big news on both of those actually later this week.
So, Ben, if the trend then is still to the upside, what do you think the gains look like between now and year end?
Probably cooler than what we've seen. I mean, just to put this in perspective, the first half gains are annualizing at the best year for the S&P 500 since 1995. That's 30 years ago. And what did we hit? Our 30th all-time high of the year yesterday. That's also putting us on track with the 77 we saw in 1995, which was the greatest in sort of recent records. So things are good. But I would expect this to slow a little bit. We've absolutely priced some of these rate cuts and some of this earnings recovery in. But there's also a lot of cash on the sidelines. So, we're overdue a bit of a pullback at some point. But if and when it comes, I think some of this money will just come off the sidelines and buy it.
Ben, what do you think is going to trigger that? Because we have, and I'll just preface that, we've had a number of conversations just about the concentration in the market, the weak breadth, the momentum that we're starting to see a bit stretched maybe at this point. Are those the factors that you think are going to cause maybe a bit of a slowdown, even though it might only be brief, it sounds like?
So your typical year in the S&P 500 has, 3 pullbacks. We've had one. And has a intra-year drawdown of 14%. We've had nothing close to that. So maybe just statistics. 1, 2, we've got a big inflation report coming up on Thursday this week. It's the most important number in markets. It drives everything from the Fed cycle to recession risks and everything else. It's been sticky. More stickiness could, especially after the gains we've had, could give us a little bit of indigestion. And we're coming into earnings season. And, this earnings story has been a one-legged sort of tech-driven stool so far. I hope we begin to see some broadening out, but we're still vulnerable to a tech earnings stumble.
Yeah, a certain bear on the street saying that the third quarter is going to be choppy and that we are due for a, quote, 10% correction. That's quite a bearish call. But then, like you say, adding that this would be a buying opportunity. And I'm just curious if every single dip in this market is viable because people want to get in on NVIDIA when it's cheaper because the fundamentals are so good, then do we ever really get a correction? Do we ever really get a drop as much as 10%?
That's a great point. And I think that's exactly why we've barely seen one pullback so far this year. Because people are, pulling those triggers early. Nobody wants to miss out, and there's, record levels of money sitting on the sidelines of this bull market. So yes, we may just continue to grind higher. This is why momentum is the strongest factor in markets. So, I think you need to be fully invested. If the pullback comes, fantastic. You get to buy some more.
How should investors be positioning themselves ahead of the election? And I guess how much volatility do you expect that to potentially trigger given the uncertainty surrounding the outcome?
I do think it's a volatility event, not a fundamental event. I think that's what we've sort of learned in the rest of the world, where we've had surprises from India to Mexico to France. When you're sitting on gains and volatilities at record low levels, which is where it has been globally, you've definitely had some volatility, and investors reacted to that. But I think, on the one hand, the US election is the granddaddy of them all, and it started early. US equities, 65% of global market cap, nowhere to hide. It's not France, let alone, anywhere else. But, these are the two best known candidates that we've ever seen. They've both been presidents before. And I think one of the interesting things in the reaction to the Biden debate, last week, the firming up of these market, expectations that Trump's going to win the election, markets just sort of sailed through that. Bond yields went up a little bit. There was a little bit of volatility, but basically, I think markets have made their peace with a Trump presidency, and I think it's as simple as looking back to the first term and saying, I did okay then.
All right, we'll see how this all plays out. Ben Laidler, great to talk to you again. Brandesco's BVI Head of Equity Strategy. Thanks so much.
Thank you.